It is entirely possible to have $100,000 sitting in a checking account, zero debt, a six-figure salary, and a painfully average credit score of 680. At the same time, someone earning $35,000 a year who relies heavily on multiple credit cards to navigate their monthly expenses can comfortably sit at an 810. When you first hear this, it feels like a mistake in the system, but it isn't. It is the system working exactly as it was designed to. Most people operate under the assumption that a credit score is a measurement of their financial responsibility. They believe it reflects how much money they have or how securely they manage their wealth. It doesn't. Your credit score has absolutely no idea how much money you make. It cannot see your savings account. It does not know your net worth. It is simply an algorithm that measures one thing: your historical interaction with borrowed money. And because it is an algorithm, it operates on fixed rules. Once you understand the specific data points it looks for, you realize there is a massive gap between how banks tell you to manage your credit and how the algorithm actually grades you. Today, we are going to look at the mechanical loophole hidden in the timing of your payments. It is a structural inefficiency in the way credit is reported. And once you understand how to navigate it, you stop playing the game by the bank's rules and start controlling the exact data the algorithm receives. If you were like most financially curious people, you were probably taught a very simple rule for managing credit: use your card for daily purchases, wait for the bill, and pay the entire balance in full by the due date. If you do this, you never pay a single cent in interest. You are demonstrating perfect financial discipline. Yet millions of people follow this exact advice, only to watch their credit score plateau in the low 700s. They check their app month after month, expecting their responsible behavior to slowly push them toward that elite 800 mark, but the number refuses to move. Worse, sometimes it randomly drops 15 points, even though they did not change their spending habits at all. This creates immense frustration. You are doing everything right, but the system is penalizing you. To understand why this happens, we have to look at the blind spot in how most people process their monthly financial routine. The core misunderstanding comes down to how banks label the dates on your account. Every credit card has two very different, very important dates attached to it every single month. The bank goes out of its way to draw your attention to only one of them. The first is the due date. This is the day your payment must be received to avoid late fees and interest charges. In the bank's eyes, this is the operational deadline. The second date is the statement closing date. This is the day the bank tallies up all your transactions for the previous 30 days, finalizes your monthly bill, and most importantly, takes a snapshot of your account to send to the credit bureaus. Here is the part most people do not realize. The credit bureaus do not care about your due date. The algorithm that calculates your score does not monitor when you actually transfer the money from your checking account. It only receives data once a month, and that data is strictly based on what your balance looks like on the statement closing date. The informational gap here is profound. Your due date is usually about 21 to 25 days after your statement closing date. Which means if you follow the standard advice, if you wait to get your bill and pay it on the due date, you are completely missing the algorithmic deadline. We will look at exactly how this damages your score in a moment, but first we need to understand the underlying mechanic the algorithm is actually trying to measure. 30% of your entire credit score is determined by a metric called credit utilization. Simply put, utilization is the percentage of your total available credit that you are currently using. If you have a credit limit of $10,000 and you have a balance of $3,000, your utilization is 30%. The algorithm is programmed to view high utilization as a signal of financial distress. The closer you get to your limit, the higher the perceived risk that you might default. For optimal scoring, the algorithm wants to see your utilization under 10%, and ideally between 1 and 5%. Now, let's connect this to the two dates we just discussed. Think of credit utilization like a GPS navigation system pinging a satellite. A GPS satellite does not record your speed for your entire road trip. It does not know if you drove perfectly smoothly or erratically. It simply pings your car at one highly specific moment in time and records your exact coordinates at that exact second. The credit bureaus work the exact same way. They do not monitor your account throughout the month. They ping the bank on your statement closing date. Whatever balance is sitting on your card on that exact day is the balance that gets permanently recorded for the month. It does not matter if you pay that balance off completely 3 days later. The snapshot has already been taken. The data has been logged. The algorithm has already made its judgment. This brings us to the actual mechanics of the loophole. Let's look at two different financial profiles to see how this plays out in reality. Imagine two investors, David and Elena. Both are 28 years old. Both earn $68,000 a year. Both have a single credit card with a $5,000 limit. They both use their credit card for rent, groceries, and utilities, spending exactly $3,000 every month. On paper, their financial habits are identical, but the algorithm treats them completely differently based on when they execute their payments. David follows the traditional advice. He spends his $3,000. On the third of the month, his statement closes. The bank records a $3,000 balance and reports it to the credit bureaus. David receives his bill in the mail, and 20 days later, on the due date, he pays the entire $3,000 out of his checking account. David pays zero interest. He is perfectly responsible. But what did the credit bureau see? On the third of the month, when the satellite pinged the account, they saw a $3,000 balance against a $5,000 limit. They calculated David's utilization at 60%. The algorithm flags him as a high-risk borrower who is highly reliant on debt. His score drops to 690 and it stays there, month after month, even though he never carries debt into the next billing cycle. Now let's look at Elena. Elena understands the mechanical reporting loophole. She also spends $3,000 a month, but Elena logs into her account 3 days before her statement closing date. She checks her current balance and pays off $2,950 right then and there. 3 days later, the statement officially closes. The bank takes its snapshot. What do they see? A balance of just $50. They report that $50 balance to the credit bureaus. Against a $5,000 limit, Elena's utilization is calculated at exactly 1%. Elena then waits for her due date and pays the remaining $50, completely avoiding interest. The actual amount of money leaving David and Elena's bank accounts every month is identical. Their income is identical. Their spending is identical. But because Elena manipulated the snapshot date, the algorithm categorizes her as an incredibly low-risk borrower who barely touches her available credit. Her score rapidly climbs to 780. You might be wondering why Elena left $50 to report, rather than paying the entire $3,000 before the statement date. This is another fascinating quirk of the algorithm. If you report a 0% utilization, meaning a $0 balance on your statement date across all your cards, the algorithm actually penalizes you slightly. It assumes you are not actively using credit at all, making it harder to grade your current reliability. Reporting a 1% balance proves you are actively using the system, but doing so with immense restraint. But here's where this becomes even more interesting for long-term wealth building. There is a second layer to this loophole, and it involves how the algorithm handles the concept of time. For most of your credit profile, time is a strict requirement. Payment history, which makes up 35% of your score, takes years to build. Average age of accounts takes years to mature. You cannot rush time. But credit utilization, in the most widely used scoring models today, has absolutely no memory. The algorithm does not calculate a historical average of your utilization over the past year. It only looks at the data from the most recent 30-day cycle. This means if you have been making David's mistake for the last 5 years, sitting at a 60% reported utilization and a stagnant score, you are not permanently penalized. If you simply change your payment date to 3 days before your statement closes next month, your utilization will instantly drop to 1%. Within 30 days, your credit score will adjust as if you had been managing it perfectly your entire life. It is one of the only levers in personal finance where you can fundamentally rewrite your historical optics in a single month. While manipulating the payment date is highly effective, constantly logging in to micromanage your balance every month requires mental bandwidth. As you progress in your financial journey, the goal is always to automate good decisions so you can focus your energy elsewhere. This leads us to the final piece of the utilization equation, permanently expanding the denominator. Utilization is a simple division problem. It is the amount you owe divided by the total credit you have access to. If your monthly spending naturally hovers around $2,000 and your total credit limit across all your cards is $4,000, your baseline utilization is 50%. Instead of fighting the numerator by paying early every month, you can systematically alter the denominator. Over a 4-year period, as your income grows and your score stabilizes, you can periodically request credit limit increases from your bank. You do not do this to spend more money. You do this to secure excess capacity. Let's say over those 4 years, you open 2 additional strategic credit cards and request routine limit increases, bringing your total available credit to $35,000. If your lifestyle remains stable and your spending stays at that same $2,000 a month, an incredible mathematical shift happens. $2,000 divided by $35,000 is a utilization rate of just 5.7%. You no longer have to worry about paying before the statement date. You can simply set your account to auto-pay the full statement balance on the due date. Because your total capacity is so large, your organic everyday spending will naturally report at a highly optimized single-digit utilization rate. You have engineered an environment where perfect credit reporting happens entirely in the background. When we step back and look at the larger picture, it is crucial to remember what a credit score actually is. A high credit score is not wealth. It is not an asset that pays you dividends. It is simply a tool. It is a specialized key that unlocks access to cheaper capital. Whether you are eventually securing a mortgage for a home, financing a vehicle, or negotiating insurance rates, a highly optimized credit profile ensures you pay the absolute minimum in interest and fees. Every dollar you save on artificially inflated interest rates is a dollar that stays in your cash flow. And in the mechanics of wealth building, preserving your cash flow so it can be redirected into compounding assets is the entire objective. Understanding the rules of the system allows you to stop being managed by the banks and start managing the algorithm. Wealth building is a process, not an event. It requires understanding the subtle mechanics of how money moves, how it is tracked, and how to position yourself advantageously within that structure. If you found this perspective helpful and want to continue exploring the mechanical rules of personal finance, take a moment to subscribe. We have much more to cover.